Hi everyone, this is the One Point Podcast. I'm Rohit Yadav. Today we are covering the venture asset class from an emerging manager fund of fund angle. And to do this, I have Jamie Rhode joining me, who's very well known in the space. Jamie, thanks for joining in.
Thanks so much for having me. I'm excited to be here.
So Jamie is a partner at Screendoor, which is focused on backing emerging VC managers and providing the institutional investors with the exposure to funds and co-investments opportunities. And before Screendoor, she spent 8 years at Verdus, which is a single family office, also well known in the space. And she built portfolios in the emerging venture manager space, as well as private equity and hedge funds using a data-driven approach. And Jamie began her career in equity research and credit analysis in Bloomberg. So she has this diverse and multi-dimensional investment experience, which I'm sure which will be very useful in the conversation today. So Jamie, let's dive in. If you can explain and expand what Screendoor is, that would be a great start.
Yeah, Screendoor was actually started by 10 established venture capitalists.
Mhm.
They found that there was a white space in the market where emerging managers really needed guidance and mentorship. And candidly, at the end of the day, capital. That's what we all want is just money and returns.
Yeah.
And so they started Screendoor in 2021 to go back first institutional funds. And
Mhm.
the ethos of Screendoor is to provide anchor capital and to provide mentorship. So each of the portfolio GPs we back get paired with at least one to two of our established GPs. Now we call them GP advisors, and we have
Okay.
14 of them. I would say what we look for when it comes to backing an emerging manager is really because, as we'll dive into it, there's thousands of funds to back. So how do you separate which ones are good and which ones are bad? Candidly, it can be random and you're not going to know for a very long time. But at Screendoor, what we really look for is for an emerging manager, tell me about your lived experiences. So something on the professional or non-professional side needs to give you the right to be the best at sourcing, selecting, and winning.
Okay. So what you mentioned about mentorship from other GPs, this is very unique to Screendoor, right? Not everyone does it.
Correct.
So tell me the feedback from GPs on this topic.
We not only back fund ones, we'll back anyone within the emerging manager ecosystem that plays in pre-seed and seed and North America. What these GPs really gain from working with Screendoor is trusted guidance. So if you're in a founder play to pay situation, or if you're dealing with a founder breakup, or if there's an unfortunate situation where a founder passes away, or
Yeah.
you're dealing with how do I handle LPAC, operations, investor reporting. You certainly have myself and my two partners, Lisa Cawley and Lane Johnson, to help guide you, but you also
Mhm.
have access to a pool of established VCs who have been there and done that and can really be a safe person to ask where you're not going to be judged for it and it's going to help you build an enduring firm because that's what we look for. We're not backing a one-time investor. We're backing someone that's looking to build an institutional firm. And that could mean staying at 50 million or less the rest of your life. Or that could mean by fund four, you're at 500 million and, competing with the benchmarks of the world.
Great to hear what you are doing. I would love for you to dive in into this VC emerging manager ecosystem because obviously it's used as one word, but it has different meanings to a lot of folks. So if you can expand on this and paint a picture for everybody in terms of numbers, growth, and how this whole ecosystem has evolved from the past, that would be awesome.
Yeah, of course. And I love numbers. I'm grounded in using data to make my decisions.
Yeah.
And I would say when it comes to venture capital, the number of VC funds has truly exploded over the past decade. In 2010, I think there was around 1,000 funds.
Mhm.
By 2024, the US has seen over 3,600 funds launched, with more than 1,200 Fund One vehicles launched since just 2021. That's an
Wow.
insane number. And
Yeah.
actually, because of this podcast, I went in and analyzed the Screendoor data, and we've reviewed about 90%.
Awesome.
And what's interesting is because You look at the industry data, and I think what's really important when analyzing the emerging manager ecosystem or when an LP is looking to invest here is you need to make sure that you have a strong representation of the population
Hmm.
before you go and understand which ones are the best to pick. And
True.
so we looked at the median fund size of our data set, and the median fund size is around 30 million.
Okay.
The average fund size is actually around 95 million.
Wow.
And I
Okay.
would say the median is in line with a lot of the market data that we've seen. Our average tends to be a little bit higher, but I think as a byproduct of having GP advisors that we do, and then my partner Lane Johnson, her experience, we get to take a look at a lot of these spinouts, which tend to lean on the larger side versus some of the other managers that may not be spinning out of a brand name. They tend to be on the smaller side.
Okay.
But what I think is more interesting is just because there's been, call it 1,200 Fund 1 launches since 2021, that hasn't translated to broader capital access. And we've all seen that fundraising has become increasingly concentrated. I
Hmm.
think it was in the past few years, emerging managers accounted for just 15% of the capital raised, despite representing 45% of all fund launches.
Wow.
And the percentages of EMs getting funded now has gone down even more. So, why is that? It's because the market environment has changed. Nobody gets fired for investing in IBM. I think you have a lot of career risk if you're going to back a fund one or fund two with a limited track record, especially
Okay.
in this market environment, a lack of DPI. But it can be an opportunity for LPs to really
Hmm.
compound their capital at unique rates. And I mean, that's the point of Screendoor. We bridge that gap. Our thesis is simple. We seek out the best opportunities in venture capital by not necessarily backing the biggest brand names. And we want to help LPs access the hard to reach area of the market where we believe that the true alpha exists. And I think
Okay.
that the real innovation risk in VC isn't backing a fund one, it's actually ignoring a fund one because most of
Okay.
today's brand names were fund ones at some point. So if you sit out of the early vintages, it's likely hard to access those when they become established. And
Okay.
I'd say my last point, and this absolutely stems from the introduction that you had of me, so I appreciate it. I come from a multi asset class background. So this cycle and these questions around emerging managers, a ton of them, now they've all shut down. What are we going to do? Should we keep backing them? I've seen this before in the public markets. It mirrors the hedge fund world, which is just faster feedback loops in VC. And the hedge fund world actually peaked in launches around 2006, 2007. I think we all know what happens after that.
Hmm.
There was a lot of consolidation and institutionalization. And I would say that VC is actually following a similar path, especially with the wave of fund ones that were launched in 2021 to 2023.
Hmm.
And now we've seen a huge contraction in the past year, year and a half. In hedge funds, alpha decay and lack of edge really weeded out the underperformers quickly.
True.
In VC, it's just going to take longer.
Okay, just because of the cycle of VC is longer, right? You captured multiple points. So maybe we can touch upon this topic of venture cannot be painted with one brushstroke anymore, right? So obviously there are bigger managers, established managers who are probably on their fund number five and so on. And there's this emerging manager ecosystem. And within this emerging manager as well, you explain it very nicely. There could be someone at fund one but raising 30 million versus fund one raising much more. So how would you kind of combine these, or maybe within your internal discussions, internal strategic analysis, you have some bifurcation, some divisions on how you do an analysis on emerging manager ecosystem, and if you can explain on that.
Yeah, it's a great question. And I think the challenge with using the term emerging manager is that in venture, you can't have hard and fast rules or you're going to lose. And I think you
Mhm.
need to have conviction and strong opinions loosely held to be successful when playing in
Mhm.
this space. And so, to the untrained eye, you may look at a $15 million fund one and think it is very different than a $50 million fund one.
Yeah.
But
Okay.
what's really important is to ask that fund manager, are you looking to build an enduring strategy? Do you have an institutional mindset and readiness about you because you are a fund one? what have your lived experiences been? Do you have the investing muscle, but do you lack the operational piece to
Hmm.
building an enduring firm? Because some LPs out there are taxable. So K1 and tax reporting is extremely important. And I
Hmm.
think we've seen in this market environment too that you can't just rely on the latest funding round, especially if the time between the last funding round and it sitting in your portfolio has expanded. And so is there firm durability there? We really look at a fund manager's ability to crawl, walk, run. If your investing muscle does not justify a $50 million fund one, and just because you can raise it doesn't mean you should. So I
Hmm.
think it's really important to look at a manager's background and their ability to execute on building an enduring firm before you can decide if this fund one is truly of institutional quality. So at Screendoor, we will back first institutional funds. Sometimes that means a fund one, sometimes that might mean a fund three. We will also back fund two, threes, and fours,
Hmm.
and we do co-invest as well. But I think generally what we've seen, again, analyzing some Screendoor data, is that the median fund size for a fund one has been around 30 million in our data set. For a fund two, it's been around 50 million. And for a fund three, it's been around 60 million. I think when you look at some of the breakout managers and experienced spinouts, it takes the numbers higher, rightfully so. But I think that in general, the other trend we've seen is that fund size has decreased over the past 3 years for EMs. So
Okay.
if we look at the past 3 years, starting in 2023, because we have been able to capture some 2025 data. There is managers that come to us very early on, say, hey, I'm going to raise a fund next year. Can I have your perspective? Can I have your advice? Can you take a look at my deck? We will give you candid feedback on your deck. But in 2023, the median fund size was 50. In 2024, the median fund size was 45. And for 2025, the funds we've seen so far, the median fund size is actually 35 million. So I think that's a reflection of today's market environment and some of the
Hmm.
challenges around fundraising is that some fund managers coming to market or coming back for a fund two or three have just needed to raise a smaller fund and get back to investing. But I just think holistically, you have to look beyond the fund number to really understand the GP's ability to be a founder magnet, to have firm building discipline, to have the right strategy that matches your fund size and your portfolio construction. So for us, emerging doesn't mean inexperienced. It really just means untapped.
Got it. So you focused on this word enduring quite a lot and being institutional ready, right? And so for you, this fund number is not that significant, if I understood it right. How about other areas of division, like do you also think around the lines of geography? For example, right now you're just based on North America. I understand that, but you also keep a tab on other geographies, right? And specifically, if we just talk about North America, then there are topics, for example, climate, it could be AI, it could be something else. Do you also think strategically along these lines? For example, if AI is booming right now, hey, let's increase our exposure to emerging managers which are just focusing on AI. Is this something which goes into your heads while evaluating EMs?
Okay, if I haven't seen AI in your deck, I'm going to probably ask what's going on with you and how contrarian are you? I
Yeah.
think that my background and thinking with the mindset of being a multi-period investor. So our vehicles provide 6 to 7 vintage years of look-through exposure on an underlying company basis. So I'm thinking constantly over the long term. And because the feedback loops are so long in venture, to be tactical in nature is just not who I am. And I don't think that is part of the Screen Door ethos where
Okay.
we recognize that we want to capture all the sectors that exist today and all the sectors that exist tomorrow. So if we lean in too heavy into, let's just like name one area of AI, like AI infrastructure or AI in the health space,
Hmm.
we are going to be prone to hype cycles. And so I think it's more important to have consistent vintage year exposure, to build a venture portfolio that captures all of the sectors, of today and all the sectors of tomorrow. So leaning in more generalist, but being cognizant that there could be certain areas like climate tech where we may need to go a little more specialist, but have that underlying manager be diversified in their coverage of climate tech, just because you never know which sector is going to produce the biggest outlier, or you never know which founder is going to create a brand new sector, and you want to make sure that you capture that.
Got it. I want to ask this question. Can you index venture?
I would say that, especially when you look at my prior role and the strategy that we built there, I
Mhm.
don't think that you, in theory, need to build an ETF of early stage venture. If you could, you would capture the mean return, and that is highly, highly attractive. The mean return, and I've used this via multiple data sets, Burgess, most recently
Mhm.
Cambridge, the mean return, so every single solitary fund or every single solitary startup is around, give or take, 90% correlated to top quartile returns.
Okay.
So if you could index venture, you'd be, I'm not going to say guaranteed because my compliance will yell at me, but you
Yeah.
would have a high probability of capturing top quartile returns.
Got it.
So I think that from a statistical sampling exercise, if you sample or invest in a large enough sample set of the underlying population,
Mhm.
that you will have a high probability of capturing the mean or top quartile returns. You could slice it a different way and just say, I'm going to invest in top quartile managers, which is really, really hard to do. And you'd also get the ETF return of early stage venture.
Got it.
And I mean,
Got it.
at the end of the day, and we're going to talk about this later, a fund of funds leans into that diversification and leans into probably the closest you could get
Mhm.
to an ETF or indexing venture.
Got it. So let's move on to the emerging manager future because this is a more strategic discussion, right? LP allocations to emerging manager. It could take shape of LPs investing in Screendoor, or it could take shape of LPs investing directly into emerging managers. What should the LPs expect in terms of, I know you captured returns to some extent, but risk, liquidity, and so on. And liquidity aspect is getting more and more attention because of lack of DPIs currently, but it will change. Obviously, this is just part of the cycle, right? So, what is the LP expectation? What should they think about?
Yeah. And I think this is a really important question for LPs to understand and know, because the return and risk profile of emerging managers or early stage venture is very, very different than late stage venture or
Mhm.
larger established managers. And so when it comes to early stage and when it comes to emerging managers, you're going to get higher dispersion of outcomes. You're going to get more volatility. But when
Mhm.
there's more dispersion in returns, that's when you have the ability to truly compound your capital at levels you really can't find in other asset classes, because the upside that asset class or that area of the market offers is significant. And again, pulling from my multi asset class background and the public markets portfolio I helped manage, not all volatility is bad. I mean, you have to break down that standard deviation number and realize some of it is negative and some of it is positive volatility. And we've all seen that Cambridge data around how emerging managers are the majority of top 10 funds. And I know that you had David from BenCap on your podcast. There's a lot of people, and this is actually where we probably have some alignment. There's a lot of people out there that say smaller fund sizes outperform. It's all about the fund size. I
Mhm.
actually don't think that it is the fund size that is driving the outperformance. It's the fact that early stage venture has shown the ability to produce much higher returns than late stage venture. Depending on the vintage year, but looking over the past 25, 30 years, it's anywhere from 5 to 8x greater.
Mhm.
A byproduct of having smaller fund sizes means you can deploy all of that capital at the earliest stages. If you're a $500 million fund, it is not going to move the needle to invest in a pre-seed round that is 5 to 10 million in post money. You just can't
True.
write a large enough check to move the needle. So smaller funds by nature tend to be more deployed at the earliest stages where the return potential is greater. So that's why I think that a lot of people talk about these smaller fund sizes having outperformance. It's just the stage that they tend to play in, not necessarily the fund size.
Got it.
Also, what's interesting about early stage venture is that it is little to no correlated with the public markets. So putting it in the asset allocation, not just from a return standpoint,
Hmm.
but from a diversification standpoint, is hugely beneficial. But the caveat is you have to size it properly because it's longer liquidity timelines. And I
Hmm.
think that too, when it comes to backing emerging managers specifically versus an established fund that is playing in the early stages, is they're new, most likely new. And so, do they have the experience? Do they have the LPAC? Do they have the right people around the table to engage with that GP and say, hey, take some chips off the table, or don't take some chips off the
Okay.
table? Think about the market environment and the opportunity cost of selling some today or keeping it on the table. And that's, again, you asked me earlier about our GP advisors. That's where our portfolio GPs can lean on them because they've been there, done that. And some of them have made the mistakes of not taking the money off the table. And some of them
Mhm.
have market timed it perfectly. And so I think just being understanding of your LP base, being understanding of what their needs are, and making sure that you have proper end of fund life management
Mhm.
is really, really important. And sometimes emerging managers don't have that. And so that's where, for LPs that want to capture that alpha, want to capture that diversification benefit in the asset allocation,
Mhm.
can benefit from looking into a fund of funds. You typically will receive diversification across fund managers, geographies, sectors, and
Yeah.
vintages, which will smooth the outcome and mitigate the down risk. So you still have the potential to capture that upside, but you're not going to experience the extreme volatility of just investing in a couple managers. You
Got it.
also have the benefit of professional sourcing, due diligence, monitoring. I mean, in my prior role, building out an early stage first institutional check portfolio led to many, many K1s, capital calls, distributions, chasing down reporting, needing to ensure that you had proper back office to just manage the portfolio that you're building on top of having investment professionals to source, underwrite, and monitor. And so you have to think about the cost benefit of using a fund of funds
Mhm.
versus I need to build out most likely at least one and a half internally, if not two bodies, just to manage the proper portfolio. And
Yeah.
I also recognize that some LPs check sizes could be bigger than the fund sizes of some emerging managers. And so there's a lot of friction and complexity when it comes to accessing
Yeah.
this market. Sometimes they're hard to reach. Sometimes they're oversubscribed. Sometimes by the time you find this manager at Fund 3, they're not letting in new LPs, or they're only letting in $2 to $8 million worth of new capital. And if your check size is larger than that, or you're too late to the game, it can be really hard. And so I would always recommend to looking to, fund of funds as an extension of a team, a toehold into the market.
Okay.
But I am sure that you're thinking, well, what about that double layer of fees? Like, it costs me money to go use a fund of funds. And in most asset classes, fund of funds don't work on an
Mhm.
after the extra fee layer basis.
Mhm.
But the dispersion in venture, and in particular early stage, is so wide that if that fund of funds is able to access the top percentage of managers, it more than offsets the additional fee layer. And in fact, there's multiple data
Got it.
sources out there that have shown fund of funds have the ability to outperform direct strategies net of fees. So from my perspective, for LPs who want early stage exposure without having to build out a team, a well structured fund of fund can deliver access, infrastructure, insights, and it's not necessarily an outsourcing model. It can really be an extension of the strategy.
Awesome. I loved your super elaborative and structured answer. Tell what are some of the questions which come from family offices? I'm taking this example of family offices in specific because they are the ones who also want to roll up their sleeves and go into startups directly or go into emerging managers directly. And from the institutional investor side, for example, insurance firms, pension funds, and so on, they have a very detailed process, laid out process, which is embedded into data and analysis and so on. But for family offices, it could also be more emotional, right? So what
Yeah.
are some of the conversations you might have had in Screendoor with LP into the space?
Yeah, and I think that the build of Screendoor too, where myself and Lisa Cawley come from family office world, where Lane Johnson, she comes from Texas Teachers and Goldman, we understand that people want to invest in venture not just because of the returns and not just because it could be a diversifier to your asset allocation. It's really cool. It is shiny. You're investing in innovation. You have the potential to back the next huge thing that really changes the world. So I think what's really important is, especially for family offices or investors that want the co-investments and want the touch and feel of VC, is that because there's such dispersion here, there's a high risk of blowing up your portfolio if you're too concentrated in just a few startups or even just a few venture funds. And so working with a fund of funds product that provides you structurally diversified exposure to the asset class so you can still benefit from the returns but not have as high a risk to blow up the portfolio is really, really important. But I think what's unique about the Screen Door model is we're very community focused.
Mm-hmm.
We are transparent with our investment memos with our LPs, and we want our LPs to actually go and invest in the underlying managers of Screendoor. I think that we recognize there's a lot of friction, there's a lot of complexity here. We've seen family offices say that they've seen a lot of the emerging managers and that they want to just go in themselves and do the co-investment piece of it. But then they start to realize the back office and reporting piece becomes really challenging when they go to pay their taxes and they realize this K1 hasn't come in yet. And so I think it's just ensuring that investors with us get the ability to build the direct relationships with the emerging managers, have the ability to co-invest with them, have the ability to invest directly in those funds, because in this space, Screendoor can't be the only LP. I mean, we need others in the ecosystem feeling comfortable backing emerging managers. And I think it's the LPs that recognize the alpha potential here that we're very grateful for to be collaborators with us.
Awesome. From the emerging manager fundraising perspective, and you touched upon these topics a little bit, the market environment has been tough. When you gave the numbers, you already told about majority of the fundraising has been captured by the established managers, right? Around 50% or probably even more in some cases. If you zoom out your lens of looking at this ecosystem, emerging manager ecosystem, where we are in the cycle with respect to fundraising, VC fundraising, and if you can bring about the aspects of macro, for example, capital markets, the DPI squeeze, secondaries, and so on. And most importantly, like how do you foresee the next 1-2 years? I know it's super difficult to predict anything.
Yeah.
Nobody has a crystal ball, but if you take that chance, go ahead.
Yeah, I would say, and you indicated it, Fund One closes dropped by nearly 50% over the past 2 years.
Yeah.
Established firms have continued to dominate. I mean, venture is power law driven.
Mm-hmm.
It's Pareto. So no surprise that established firms have raised 80% of the capital recently. And, I think as an LP, the macro uncertainty, the rebalancing, the performance of other asset classes, the preference for brand name managers with historical relationships. Again, no one gets fired for investing in IBM. The DPI squeeze and exit slowdown has all created so much friction that emerging managers get left behind. But I think that the challenge is, as an LP, you want consistent exposure to the asset class. And even though your capital base may be less available for investment, you
Mm-hmm.
still need to ensure that you have exposure to that. And
Okay.
so I think that over the next 1 to 3 years, you'll see a lot more exits, which will hopefully allow LPs to back more managers in the space. But I also think that early stage venture funds need to look to exit potentially in the secondary markets. We
Okay.
have these discussions a lot where if you're going in somewhere between 10 million and 25 million post money valuation, depending on your fund size, if it's sitting somewhere between 500 million and 1.5 billion, you might still have the potential to return your fund. You don't need to necessarily wait for the big exit. Now,
Hmm.
again, you need to think about your LP base. Are they taxable investors? Do they even want the capital back? Should I do a distribution in kind? And so I think that this market environment is really going to enforce that emerging managers really think about end of fund life management and exits. But candidly, as an LP my whole life, that's on the LP to properly manage their cash flows. Because just because early stage venture, maybe over the past 10 years prior to this drought, you got your money back by year 8, you also have to recognize that left tail events do occur. If you look at the .com boom bust, if you look at the GFC, and now you look at the market environment today, there are periods where it takes longer to get your money back. So you need to feel comfortable with ranges, and you need to understand the risk that you're taking around the duration side of it
Hmm.
when you're making fund commitments and investments. You don't over allocate to certain vintage years, because then you're going to miss. I mean, this challenging market, it's just a sorting mechanism. This is what happened in the public markets. Durable managers will survive, and the LPs who stay active now are likely to access the best vintages in decades. I mean, that's the benefit of a fund of funds. You're getting consistent vintage year exposure, but everyone just loves to hate on the ZERP years. I mean, they're horrible. They're horrible. Well, guess what? Wiz raised its Series A in 2020 at a $100 million valuation, peak ZERP. Well, 5 years later, it was acquired by Google for $32 billion.
Yeah.
So if you could have made a magic wand and skipped 2020,
Hmm.
you may have potentially missed on a 300x return in 5 years in a very crowded, overheated fundraising market where
Yeah.
no one thought there would be returns. So to me, emerging managers and quality firm building emerging managers aren't struggling because they're underperforming. They're struggling because LPs have defaulted to comfort over conviction.
Okay. Awesome answer. I loved some of the nuances that you captured because so it's many times it's actually on LPs, as you said. It lies on LPs, their understanding of liquidity and cycles and how they manage, let's say, early DPIs in some cases, shorter cycles to 8 years versus the real cycle of venture, which is much longer than 10 years, right? Loved your answer. So let's focus on the big debate question. So there's always within emerging managers, there's always those debates happening on specific topics. And one of the topic which always comes up in so many social media conversations and kind of starts thinking of LPs who might be first time LPs and second time LPs and they might be hearing a lot of stuff from a lot of different social media angles is that specialist versus generalist, and what's your stance on this? Is it even a topic of discussion within the emerging manager ecosystem?
So when I saw this question come through, I immediately called my partner Lane and I was like, what's your take on this? I want to make sure I'm capturing like the full, perspective here. And so we both continue to see it being a mixed bag.
Okay.
We see specialists for sure, but we see a plethora of generalists. And again, I think that if you lean too heavily
Mhm.
into specialists, you can create too much exposure to hype cycles. So there's a risk associated with only doing a specialist. And I'm going to pick on fintech, but I think fintech has a wide enough swath of area to invest in that
Mhm.
nowadays fintech may not be as much of a specialist, where when I first started investing in early stage venture a decade ago, it probably was more of a specialist area. If
Okay.
you choose to invest in a fintech fund manager, if that sector takes a hit and all you have is 5 fund managers, there's a high probability that that fund manager is going to be bottom quartile, just as a byproduct of the macro and sector place it plays in.
Okay.
And so there's a lot of challenges if you're only picking a few managers and you're saying, okay, I'm picking fintech to produce an outlier in the next 3 to 4 vintage years because that's typically the investment period. and I'm picking this fund manager to find that outlier versus could I get fintech exposure through multiple fund managers? So I still get the coverage
Okay.
and I still want the GP to be experienced enough, but I'm not taking an individual fund risk on a specific sector. But there's also times that certain sectors you can't get through a generalist. I just think that sometimes you need to be seeking out the top 1% founders because they could be creating that next company. I mean, back in 2012, Coinbase got its seed funding. So if there was a blockchain crypto focused fund, I'm sure there was one out there and someone with hindsight bias is going to say they did it. But I just think that that really didn't exist at that time. And so if you
Mhm.
only went sector specialist, you missed out on creating the next sector there. But I
Mhm.
think you see a mixed bag of there. What I actually would call to is emerging managers tend to be specialists in their own way because they tend to have access to the next founder, to the next potential PayPal mafia, or to the next Stanford network, Teal Fellowship. They're accessing typically a fresher network or a newer
Mhm.
network, or there's something
Got it.
special about them. And that's where I think they're a little bit more specialist than an established manager.
Got it. So this discussion of specialist versus journalist is from your standpoint, and you have been in the ecosystem for such a long time. It's actually might be driven by forces which just want to push their own agendas, if it's diplomatically right to say, right? But
Yeah.
from a perspective of allocation to the VC managers, obviously, as you said, it's a mixed bag and you have to kind of focus on multiple dimensions. Let's focus on debate number two, which is, are there too many emerging managers? And I know you captured the numbers initially, that this whole ecosystem has grown tremendously within the last
Yes.
years, although they are finding it a bit difficult in the last couple of years to at least raise money. Where do you
Yep.
stand with respect to the size of the ecosystem? And do you agree that we need more emerging managers, for example?
Yeah. I would say there's a lot of emerging managers out there, but a significant portion of them are undifferentiated. They're, from my perspective, especially during the ZERP years, there was not many strong ones. I think that's why at Screendoor, our ethos has always been tell me about your lived experiences. Something about your professional and non-professional life
Yeah.
has to give you that edge, has to put you, and you talked to me earlier about geography. So it has to put you in the right geo and the right network to
Mhm.
access the top 1% founder, but to be able to see the non-consensus and be right. Because you're likely going to be competing with other firms at some point in your journey. And so I need that manager to be able to see that opportunity differently, to be able to capture the insights and inflections in the marketplace that have occurred over the past few years to make this opportunity work today. And so to me, there always needs to be more high quality emerging managers. It's actually why the GP advisors, so the established funds that started Screendoor, Satya and Hunter at Homebrew, Charles at Precursor, they wanted to start Screendoor because they wanted to fund their competition. They wanted to get exposure and make sure that they're helping fund the next high quality emerging manager to keep the competition strong. Because when you have competition, that tends to lead to better outcomes for the population that's
Mhm.
having exposure here. So I think it's really important that if you believe in innovation, that you continue to bet on this part of the market.
Awesome. And may I put forward this line? So this is what I'm thinking about is the bar should to start an emerging manager VC fund should be higher, which is to say that you should really think through whether you want to start it, whether your strategy is differentiated or not. So the bar on that level should be higher, but it should be easier to build your firm thereafter, right? So that's
Yes.
kind of the way it should look like. I don't know whether you agree to it or not.
Yeah, I would say, and there's many flavors of an emerging manager where, especially with like family offices or high net worth individuals, if there is an opportunity for right now because this individual has access to some special network that works today,
Hmm.
and they want to do it one time, sometimes that works for investors, and that's okay too. And we've seen a plethora of call it fund zeros or fund ones that don't have audited financials, that they're doing this part time, that's okay. And they can exist for the right type of investor. That's
Got
not
it.
someone that we're going to back at Screendoor. But I do agree that the bar to start an institutional venture fund needs to be higher. I just think that the pathway from going from investor to fund manager is really challenging. That's why
Okay.
Screendoor exists to help with that. But you need to have the right mindset.
Okay. I will capture this third and the last debate question of emerging managers and where they stand. Do you think within this current environment and the way the whole ecosystem has grown, we are entering an era where probably the emerging managers might fail more often and might close more often? So typically, we are coming from an era where venture capital is a long term asset class. Once you're invested, you stay in there for 10 years, you go through multiple cycles and so on. But are we, from an emerging manager perspective, entering an era where there are too many firms and then we might see closures more often because, obvious, for reasons that we discussed, the DPR might be low, the performance could be different, and so on. So, what do you think on this topic, and how should kind of LPs prepare for it in future? Because then they need to look at the whole ecosystem from a perspective of not just, hey, we are there for 10 years, but okay, we might need to look at more and more fund managers, or we might need to allocate to somebody like Screendoor for better exposure throughout the cycle.
Yeah, I would say that emerging managers are maturing faster, but some
Mhm.
are shutting down sooner. And this is where, in the underwrite piece, and this is where my colleague Lisa, she spikes on this.
Okay.
Her and I met family office world pre-COVID, chatting about investments together. But people forget how important operational due diligence and LP negotiations are.
Hmm.
Because when partnership breakups happen, which we've been seeing in the market, when fund managers choose not to raise again or they want to shut down, you still have a vehicle that you said 10 years, I'm going to say 15 years, is going to be around and needs to be managed properly. Because just because the investment period's over,
Yep.
we all need DPI at some point. And so ensuring that the operations of the firm are set up properly, ensuring that the LPA is of institutional quality really matters when things go wrong. And when you end up investing in enough funds, whether it's venture, buyout, real estate, whatever asset class, something is going to go wrong. It's
Yep.
just a probability that that's going to happen. And so I really think the legwork up front is truly, truly important. And so I think that looking for firm builders,
Hmm.
underwriting the team expansion, ownership, culture, succession planning, strong founder references are really, really important, but also ensuring that the operations of the firm are set up properly. The real emerging manager shakeout, I don't think is truly about
Okay.
capital scarcity. I think it's really about operational maturity. And the ones who treat a fund one like a fund four
Hmm.
will win. And the winners in venture won't be by those who have time macro. It will be the ones that remained consistent, build relationships early, and scaled over time properly. And so I think that having long term exposure to this part of the ecosystem allows you to capture that compounding upside that I spoke
Yep.
about before. And so when it comes to venture, it's really, really important to back the right managers. Only 20% of early stage venture funds get you a 3x net or greater.
Hmm.
And
True.
if you're going to lock your money up for a long period of time, you better be in the right funds. You know, if you invested $1 million a year from 1982 to 2018 into early stage VC, your median TVPI, so the 50th percentile,
Hmm.
is around a 1.9, 1.95x, depending on the data set that you look at. But if you were top quartile, you'd get the 3x.
So the difference in the dispersion is quite huge. And with those words, thank you, Jamie, for joining in and covering so many topics in such a detail
Yeah.
about emerging manager ecosystem and how, most importantly, to capture the future on how LP should think about it. Obviously, Screendoor plays an excellent role in all of this, and wish you the best in your journey.
Thank you so much for having me. This was so much fun.
Thanks, Jamie.